are making it easier than ever to earn from digital assets. Now, New York-based Blueprint Finance announced its $9.5 million raise to expand its DeFi platforms earlier this year. Now, the crypto lending market now tops $36 billion, with institutions and retail investors getting involved as DeFi continues to expand into mainstream investing. Joining us from Solana's Breakpoint this morning in Abu Dhabi is Nic Roberts-Huntley, founder and CEO of Blueprint. Nic, happy Friday. Thank you so much for staying and joining us today. So first and foremost, you've been spending time in Abu Dhabi, attending not just Breakpoint, but Abu Dhabi Finance Week, as well as the Milken Institute's gathering. So give us an idea of how the UAE has managed to position itself as the global meeting ground for digital assets and crypto, and what you're actually seeing on the ground there.
I think it's been pretty obvious in the last couple of weeks just the quality of capital and financiers that have been in attendance. And I think that's largely been drawn in by the quality of the regulatory frameworks that you get across both the state level across the UAE, but also in the regulated zones, both between ADGM and DIFC. And so it's one of the few places that you see significant players in the space, both in traditional finance looking to explore digital assets, but also large global exchanges come for a base of operations with like global reach and significant depth of capital.
And I do also want to get your take on what you're seeing when it comes to the licensing front as we head into 2026 and beyond.
I think we've seen a plethora of interesting developments as far as regulatory frameworks in the stablecoin space in 2025. I think what we're yet to see now is how those play out and the utility of stablecoins across real world use cases in both payments, infrastructure, and particularly the intersection of payments within AI. That seems to be a common topic of conversation here. The frameworks as to how, where I spend most of my days in the kind of decentralized finance realm and delivering yield, generating returns for slightly more institutional grade capital, the utility of the assets that have been used in and around and formed around DATs is yet to be determined. And I think as we see next year approach, we're going to have to start receiving and making significant roads into how we get assets to work efficiently across DeFi from slightly more structured financial environments. The UAE particularly seems to be more structured and more robust in a multi-layered approach to regulatory frameworks, but I think everybody is certainly on the ground here trying to figure out what next year looks like from a regulatory perspective, what we will or won't be able to get done with the assets on people's balance sheets.
You mentioned two key words there, Nic, yield as well as regulation. I understand that you have said institutional yield is the next big step for digital assets. So what changes in regulation or market structure do you think are needed to unlock some of that dormant capital?
I think from a regulatory perspective, in terms of recognizing gains, it's largely going to be coming under the framework of what is or isn't treated as a commodity or a security across how those assets are put to work. Money markets or traditional DeFi lending are a common place to derive yield, but representing and accounting for that effective debt or credit structure on people's balance sheets at an institutional level can become extraordinarily complex. So the question will be, will we afford large regulated financial institutions the capability to approach those venues and trade with the appropriate KYC and AML flows and checks? Or will we have intermediaries, more native blockchain or DeFi companies provide those services up to regulated financial institutions? The second piece about why is institutional yield kind of the next big space and what does it need from a market structure perspective? I think for us, it really comes down to the ability for the market to receive the depth that is interesting for large partners to take on the risk or the amount of exposure they need to generate meaningful cash flows. We're talking about multi-billion dollar books looking to get to work in DeFi. It's very hard at present to find many opportunities to put more than $1 billion of capital at work in any one venue. And we need to see an increased amount of capacity across the system for that to scale and really make a dent into people's balance sheets.
And as we look ahead to next year, you're currently in Abu Dhabi and joining us from Breakpoint. This year we have been seeing rotation toward L2s as well as Solana. So give us your take on what this shift actually tells you about where settlement as well as execution may be headed.
I think that Solana has for a long time been one of the better businesses across crypto, an incredibly performant network from a revenue perspective. It caught a lot of the mimetic trend for the last few years where we saw a lot of obviously meme coin trading and speculative activity going on, but fundamentally it's a fantastic platform for technology. I think next year will be extremely performant for Solana. We're very excited about it. We obviously have a protocol and manage capital actively in the space. I think this long kind of battle between EVM maxis or Ethereum maxis and Solana maxis is kind of falling by the wayside, and they'll both find their independent place. We've certainly seen a proclivity and a strong argument for why Solana is the right place for payments, settlement, high transaction speed and stability. But again, I think there's plenty of option in the room for both the kind of Ethereum space as well as the Solana space to own the flows, which will be meaningful for both organizations and communities and builders alike.
And finally, before I let you go, there are a lot of headlines out there when it comes to digital assets, not just in the US, but also overseas. So separating that signal from that noise is important. And I understand you expect accelerating M&A across custodians, exchanges, as well as infra providers. So tell us what you think is driving this consolidation and who actually stands to benefit here.
100% extraordinarily strong opinion on the fact that we'll see a massive proliferation in M&A across the digital asset space, and for two reasons primarily. One, we've seen compressed rates of return in traditional financial instruments for a little bit of time now, and digital assets seem to be an interesting area of exploration and potentially significant improvement on rates of return across large books of capital. The second piece is people forget that digital assets from a builder's perspective and a talent perspective is still a relatively small industry, meaning that the really high-grade talent, the great engineers and the great protocols are harboring a lot of the people that would take those organizations to the next level. Recruiting them out en masse is extraordinarily challenging. And from a speed and a capital efficiency perspective, I think it's going to make a lot of sense for some large organizations to take on the better players in the space, particularly around DeFi and infrastructure in digital assets over the next 12 to 18 months.
Well, Nic, we will have to leave it there, but thank you so much for joining us today. And as always, thank you so much for sharing all of your insights and your perspective.
Thanks so much.